So the OECD just dropped its latest economic outlook, and wow, it is a real page turner. It tells this incredible story of surprising strength, but also hidden dangers. You've got these two massive forces pulling the global economy in completely opposite directions. Let's get into it and unpack what's really going on. After the most aggressive interest rate hikes in 40 years, pretty much every expert was bracing for a recession. Everyone was expecting a global slowdown, a real hit. But that's just not what happened. The global economy didn't just hang on, it showed this incredible resilience, this ability to just absorb the shock. And here it is. This is the headline number that really caught everybody off guard. 3.2%. That's what the OECD is projecting for global growth in 2025. Now, on the surface, that looks fantastic, right? Incredibly strong. But as we're about to find out, that number is hiding a whole lot. Right, because underneath that shiny number, the OECD report uncovers a whole web of risks. It's a total paradox. The very things that seem to be holding the economy up might also be the things that could bring it all crashing down. This is really the two-sided coin of the 2025 economy. Okay, so let's dive into that first part. Where is all this good news coming from? What is making the economy so tough all of a sudden? This quote from the report is basically the theme of the year. It means the world somehow managed to handle all this huge financial pressure without completely falling apart. But, and this is a big but, the report is quick to point out that this strength isn't exactly natural. It's being propped up by some very specific and probably temporary factors. And one of those big factors is something called front-loading. Think of it like this. Companies knew that new trade tariffs were on the way, so they rushed to order and stockpile everything they needed beforehand. This created a massive, but totally artificial, spike in economic activity. It's kind of like stealing demand from the future to make today look good. And that's a huge reason why the OECD sees growth slowing down to 2.9% in 2026. Eventually, the bill for all that borrowed activity has to be paid. Okay, so if some of this resilience is just a temporary illusion, there has to be something else, right? There must be a real, powerful new engine pushing us forward. And according to the OECD, there absolutely is. And it's probably the single most important factor shaping our world right now. And that force is, you guessed it, artificial intelligence. The OECD report makes it crystal clear. The AI boom is playing a wild double role. It is both the economy's greatest hero and potentially its biggest ticking time bomb. So normally, when interest rates are this high, businesses pull back on spending. But we are in the middle of a full-blown AI arms race. Tech giants are pouring billions and billions of dollars into data centers, chip factories, you name it. This spending spree is so huge, it's basically acting like a government stimulus package, but it's all coming from private companies. The OECD is blunt about it. Without all this AI investment, we would almost certainly be in a global recession right now. This slide just captures the two faces of AI perfectly. On the left, you've got this incredible engine driving investment and saving us from a recession. But on the right, you see the bubble. You see financial markets getting way ahead of themselves. The report uses phrases like stretched asset valuations, and it's basically drawing a straight line to the dot-com bubble of the late 90s. The promise of AI is real for sure, but the market is acting like all that promise has already paid off. And the danger here isn't just about some tech stocks taking a tumble. The OECD points to a really specific weak link in the financial chain: non-bank lenders. We're talking about hedge funds and private equity firms that have made huge, super risky bets on AI. If that first AI domino falls, they could be forced to sell off assets in a panic, triggering a nasty chain reaction across the entire financial system. So this brings us to the core conflict, right? We have this incredible supercharged AI engine pushing the economy forward at full throttle. But at the exact same moment, another really powerful force is just slamming on the brakes. And the OECD says this braking force is getting stronger every single day. And that braking force? It's the return of global protectionism. You could say that while AI is connecting the world digitally, our trade policies are physically pulling it apart. I mean, just look at this slide. The scale of this shift is just wild. For decades, the average U.S. tariff rate was about 2.5%. Today, it's around 14%, and it's projected to hit almost 20%. We haven't seen levels like this since the 1930s. This signals a fundamental break from the whole era of globalization. And what this means for you is actually pretty simple. higher prices on everything, from cars to phones. And the direct result of this new trade war is a major slowdown in global commerce. You can see it right here. The OECD expects global trade growth to fall to a historically low 2.3% in 2026. This isn't just some abstract number. It's a clear sign of deglobalization happening in real time, making the world a less efficient and, frankly, more expensive place. So you have this global tug of war between technology and tariffs. But is this battle playing out the same way everywhere you look? The clear answer from the OECD is no, not even close. In fact, one of the biggest stories of the 2025 economy is divergence. Different parts of the world are on completely different tracks, creating this really clear landscape of winners and losers. You really can't talk about a single global economy anymore. It just doesn't exist. I mean, look at this table. You've got the US plugging along at 2%, Europe struggling to even get over 1%, China managing its slowdown, and then you've got India just absolutely crushing it at 6.7%. Every single region is telling a completely different story. And this slide really nails the difference between the two big Western economies. On one hand, you have the US, whose economy is basically running on a treadmill powered by government debt, a path the OECD literally calls unsustainable. On the other hand, you've got Europe, trying to run a race while tied to a big weight of budget cuts, which is making its recovery, in the report's words, anemic. But there is one major bright spot in Europe, and that number, 2.9%, that's the projected 2025 growth for Spain. That makes it the fastest growing large developed economy in the entire world. It's this combination of booming tourism, smart use of EU recovery funds, and a really strong job market that has made Spain the continent's absolute standout performer. So let's bring this all home. On one side, you have the explosive, stimulating power of the AI investment boom. On the other, you have the choking, inflationary drag of the new trade war. The entire global economy is walking a very, very thin tightrope between these two realities. Look, if you take away just 3 things from this whole explainer, make it these. First, that headline growth number is real, but it's being doped up by temporary fixes like AI spending and government debt. Second, these trade wars aren't just a passing phase. They are a permanent feature of our new economy. And third, the AI story really only has 2 endings. Either it leads to a historic productivity miracle or its financial bubble pops and triggers a massive correction. And that is the central question hanging over all of us as we head into 2026. The world has shown this amazing balance so far, but the crosswinds, the promise of technology on one side and the risk of breaking apart on the other, they are getting stronger. The OECD report doesn't give us the answer, but it makes the stakes incredibly clear. Which side of this two-sided coin is ultimately going to land face up?